a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
You know, we may be pushing the season just a little bit, but we're going to talk about this anyway. ETFs and taxes with our ETF research director, Nina Mishra, who joins me now. So some ETFs are tax smart.
Yes.
Okay.
We'll
start with that.
Yes. Compared to similar mutual funds, ETFs are tax smart. And in fact, it may be the right time to talk about tax efficiency because it is the capital gains distribution.
Yeah, and we're going to get into
season.
that too. Yeah.
Yes. So many investors, mutual fund investors, may get this unpleasant tax bill, capital gains tax bill, even if they may have unrealized losses on their mutual fund investments, because we know the broader indexes this year, they are either just slightly in the green or many are in the red for the year. So you may have unrealized losses on your mutual fund investments, but you may get capital gains bill because your mutual fund manager might have sold shares to meet investors' redemptions. And in fact, many investors have been pulling money out of actively managed funds, actively managed mutual funds. And because of the bull market for the last 9-10 years, many of those holdings, underlying shares in the mutual funds, they are sitting at huge gains, huge appreciations, and those capital gains will need to be distributed to investors, even if investors have unrealized losses on their investments.
That's interesting, and that's an important point. Getting back to ETFs, though, the new tax laws, how are they impacting ETFs now that the new tax law has been signed? Anything new there?
No, nothing new in particular. But as far as the new tax law is concerned, ETFs and mutual funds, they will have the same treatment. So if your ETF has realized capital gains, you will have to pay taxes. ETFs are not exempt from taxes. But most ETFs, they track well-known market indexes. So that is why they have much lower turnover compared to actively managed mutual funds. For example, the most popular ETF, the SPDR S&P 500 ETF, SPY, has a annual turnover ratio of just about 3-4%. So because of the low turnover, ETFs have fewer taxable events and fewer taxable gains. But more important than that is the ETF's structure. ETFs are more tax efficient compared to mutual funds due to the way they are structured.
That's interesting.
And in fact, on this slide, I have a picture of ETF structure which results in tax efficiency. So in case of ETFs, creation and redemption is basically between the authorized participant, known as the market maker, and the fund custodians. And these are in-kind transaction. No cash is involved. Shares go out, shares go and shares come out. So these in-kind transactions result in lower taxes, whereas in case of mutual funds, it's cash in and cash out. So whenever investors redeem their mutual funds, they sell their mutual funds, the manager will sell underlying holdings, and that will result in taxable event, and that those taxes, the capital gains, they will have to be distributed to mutual fund, all holders of mutual funds. In fact, according to iShares, over the last 5 years, 55% of mutual funds paid a capital gains distribution versus just about 10% of ETFs. Now, in the last couple of years, because stocks did so well, so investors probably did not mind paying a capital gains tax on their investments. But this year it is going to be painful because they may have losses or barely any gains, but they may still have to pay capital gains taxes.
See, that's what's interesting to me. If I have an ETF and I haven't sold my ETF at all. But whoever's managing my ETF has sold shares that are in that ETF. I may get tagged for that.
Not for ETF, but for mutual funds, yes.
Okay.
Because in case of ETF, when your manager sold those shares, that was an in-kind transaction.
Yeah.
But in case of mutual fund, if your manager sold shares to meet investor redemptions, that was a cash transaction and a taxable event. So that is the main difference between ETFs and mutual fund structure. And that is why if you hold an ETF and a similar mutual fund in a taxable account, we are not talking about tax exempt accounts here,
Yes.
in a taxable account, then most likely the ETF will result in lower tax liability for you.
Okay, so that's why the ETF is efficient.
Yes.
Right, because of
Yes.
that difference.
Yes.
When is the ETF not efficient?
So we should mention that not all ETFs are tax efficient. For example, fixed income ETF, the bond ETFs, the managers have to sell bonds at times to adjust for duration and target maturity. So they create taxable events at times. Bond ETFs are not very tax efficient. They do pay out capital gains distributions, but usually those distributions are minimal. Then there are inverse and leveraged ETFs. They are also not very tax efficient because they reset daily, and that daily reset may result in significant short-term capital gains taxes. Then there are currency hedged ETFs, which hedge out the foreign currency exposure. So they use forward contracts and other derivatives. And whenever the US dollar appreciates significantly against other currencies, like the case this year.
Yes.
Earlier this year, the dollar appreciated significantly. So those currency hedged ETFs, the contracts that they use to hedge the currency exposure, those contracts must be in profit. They must have had gains, and those gains would need to be distributed to investors.
Interesting.
And then there are precious metal ETFs, for example, the gold ETFs, GLD. That is treated by the IRS as holding the bullion itself, holding the precious metal itself.
Yep.
And those are treated as collectibles by the IRS, and they have higher long-term gains taxes. So that is something investors need to be aware of. Similarly, MLP ETFs that have more than 25% of their assets invested in MLPs, they're structured as C corporations and
Yep.
taxed as C corporations. And in those cases, assets are required to be marked to market, and deferred tax liabilities that need to be recorded in case of unrealized gains. So that is why in case of some of the MLP ETFs, you may see large tracking error, large differences between the index's performance and your ETF's performance. So if you are thinking of buying an MLP ETF, maybe look at the performance versus the index's performance, and you will know if there are large tracking errors.
All right, what about bond ETFs? Any implication here?
So bond ETFs, because of their frequent adjustment of duration and maturity, they sell bonds at times. So that is why they are not as tax efficient as equity ETFs.
Okay. Well, hopefully we got the viewers thinking a little bit ahead of time about how they may treat this type of investment in the new year anyway.
Yes, exactly. So if you are thinking of buying a mutual fund, maybe look at the tax implications, and
Sure.
maybe you can find a similar ETF if you want to avoid huge capital gains liabilities.
And always smart to get a head start on that type of thinking.
Yes.
All right. Well, we thank you for that. Hopefully we didn't take you out of the holiday spirit at all by talking about taxes. But if you want more ETF information, it's always on our website. All you need to do is go to Zacks.com, use the Funds tab in the top toolbar. It'll take you right to it. And don't forget Nina's podcast on ETFs. You'll hear a lot more information and a lot of conversation with some interesting folks in that podcast. That's on the podcast page at Zacks.com. With Nina, I'm Terry Ruffalo.